Hi, in this video we'll talk about how fairly valued are American stock markets currently by looking at two prominent indicators. Let us begin with Shiller P. Shiller P ratio or CAPE is a cyclically adjusted P ratio usually applied to S&P 500 index. Simply put, it is a PE taking into account 10-year earnings average adjusted for inflation. It is one of the tools you use when you want to gauge how historically over or undervalued are the stock markets. Here's the chart of Shiller PE spanning as far as 1880s. I have drawn these vertical red lines to try and show you these huge cycles that stock markets are going through over and over again. These cycles usually take around 30 years. And it is quite amazing that the length of those cycles is very consistent. I mean 30 years, 27 years and 32 years. It has been very consistent so far. And we are currently at 14 years into the cycle, which is about the half, and we've got another 15 years or so to go to complete this current cycle. Unfortunately, what you will notice is that the first part of the cycle is usually marked by inflation in Shiller PE. Look at this part, this part, this part, and this part. It's the periods of abrupt growth in the stock markets. The second halves of the cycle are usually deflationary, however, and lead to stock markets falling down or growing very slowly but in a volatile manner. Also in this second half, the stock market crashes often occur. Now we don't know if we are currently behind the peak of this cycle when Shiller PE was at 39 in November 2021, which is right there, or if we still have a space to go upwards. But historically you can tell the Shiller PE is rather high currently, suggesting stocks are not really cheap. Here I have drawn orange curves to show you this beautiful cyclicality of stock markets in the long run. And it looks like we're currently at the peak, or that we'll be approaching this peak in the next few years. Again, here's the November 2021 that might have marked the peak of this current cycle. And in this chart I have drawn vertical green lines inside those greater cycles. These lines show us the peak in the cycle and how long it took from the beginning of the cycle to reach this point. So in the first cycle spanning from 1920 to 1950, which is there, the peak was reached in 1930, which is also when the Great Depression began, followed by abrupt stock market crash. The next cycle reached its peak after 16 years from the beginning in 1965. The dot-com bubble was 18 years from the beginning, and the current cycle might have marked its peak in November 21, which would be 12 years from the beginning of the cycle. Now let us make it a bit more interesting and calculate the returns that S&P 500 realized over the given periods, and below you'll find in parentheses the numbers that are inflation adjusted. So for instance, from the peak of 1930 to the bottom of 1950, the stocks have fallen 55%, and inflation adjusted, you would have lost almost 70% of the value of your initial investment. This was the worst period for stocks. But of course, many investors did not buy at the peak of 1929, so if they bought later, when asset prices deflated, their returns would be substantially better. Now looking forward, the next cycle began in 1950, and it took 16 years to reach the peak, during which the stock markets returned 553%, which is more than 6x of your initial investment, and inflation adjusted it was increase of 400%, still remarkable. Going down from this peak in 1965 to the trough in 1980s, stock markets would have returned you almost 30%, but inflation adjusted you would have actually lost 55% of your initial investment. This period of 1970s is often compared to today, where there were 3 huge waves of very high inflation. So even though stock markets went up a bit, you would have lost more than half of the value of your money despite positive returns. Now, the dot-com bubble cycle was the best period to invest, where from 1980 till 2000 the stock markets have reached their peak and returned you incredible 1130%. Inflation adjusted, it is significantly lower, 572% return. But hey, it was still the best period to be invested. After the dot-com bubble started to slowly deflate, this marked the second half of the cycle that ended up in a 50% top-to-bottom loss and 61% loss inflation adjusted. And finally we are getting to our current cycle. that began in 2009, and from this point onwards up until our hypothetical peak in November 21, the stock markets have returned 545% or 411% inflation adjusted. Now, what amazes me is not only the consistency of the length of the cycle, which is approximately 30 years, but also the losses and returns during those cycles. In the growth period of the cycle, you would have returned inflation adjusted 400% or more in a decade or two. In the second part of the cycle, where valuations were deflating, you would have lost on average 60% of your initial investment. I mean, the dispersion of these values is quite low. If it were to be true and 2021 really marked the top of this cycle, we're probably in for the lost decade, especially for those who invested at the peak. In the future, I will do video about the best practices during those so-called lost decade periods, so please subscribe if you don't want to miss it. Here in this chart I have calculated the most recent performance. S&P 500 lost 5.5% of its value from the peak of 2021 and 15% if you adjust it for inflation. So investors are already bleeding. If the average peak to trough was 60% fall, then we still got ways to go in the next decade or so. So what Shiller P shows us is that stock markets are moving in huge cycles and that buying at or near the peak is very painful. Starting from 1980s here, the whole curve moved to higher values. This is due to the ZIRP environment or the zero interest rate policy environment. If interest rates are low, the cash and bonds become less attractive and essentially the only thing investors are left with are stocks. This implies higher demand and cash inflow into the market, which props up the valuations. Now, some of the best informed people in the world today are thinking that structurally higher inflation is here to stay for quite some time due to deglobalization, wars, fiscal spending, populism, etc. Should this be true, then interest rates will have to be consistently higher, which should, in theory, push valuations down closer to the historical mean of around 17 points. Currently, we are sitting at 31 points, which is considerably higher, and it is not going down yet, because markets are currently reliving the zero interest environment and still don't believe that it should be gone. I don't know which is the truth, but if interest rates truly go down to zero again and stay there, I think markets are yet to reach a new peak in this cycle. If rates are going to be consistently higher in the next years due to entrenched inflation, well, then 2021 might have been truly a peak. But nobody really knows. The time will show us. There's another way to look at the stock market valuations, and that is by calculating earnings yield and equity risk premium. For that we will need P/E ratio of the S&P 500 index. Unlike Shiller P, which takes into account 10-year average earnings, this approach takes either trailing, i.e. the past earnings, or the forward earnings that analysts expect to realize in the next 12 months. Looking at this chart by Dr. Ed Yardeni, you can see the forward P ratios of S&P 500, S&P 400 mid-cap, S&P 600 small-cap, and the Magnificent 7, or in this case 8. Those 7 or 8 US mega-cap stocks have driven virtually all of the stock market's growth during this year. If you exclude them, the index S&P 493 would be flat in 2023 or even slightly negative. Obviously, their valuations are out of the norm, with forward PE being 28. Beware of those. They lifted the stock markets up, and in case of a more serious economic downturn, it is possible they will be the ones dragging markets back down. Now, back to index. S&P 500 has forward PE of 18.6. It isn't extreme, but historically still elevated number. Medium-sized companies or S&P 400 mid-cap had forward PE of only 13.4, which is much more reasonable valuation that is actually below the average of the last 2 decades. So now, we know this. Historically speaking, S&P 500 seems to be rather expensive, and even more so are those megacaps. Smaller, medium-sized and small-sized companies, on the other hand, offer historically better valuations. It might be helpful though to relate these ratios to the current macro environment. In this little table, I have used P ratios to calculate the earnings yield of the given group of stocks, which in other words tell you how much return you can roughly expect. It's done just by taking reciprocal of P ratio. The earnings yield must be compared with the yields on US Treasury bonds, because that is your opportunity cost of investing in stocks. Currently, the 10-year yield sits at 4.5%. And finally, equity risk premium is calculated by simply subtracting the treasury yield from earnings yield. Resulting values are, for the vanilla S&P 500 index, we've got equity premium of only 1%. Put simply, this means that you're rewarded just 1% more by undertaking the risk of investing in stocks instead of the risk-free treasury bonds. Median risk premium, which is the row below, shows us 1.8%, which is a little bit better deal. S&P 400 mid-cap has equity risk premium of 3%. That is closer to the historic norms, but still nothing to be excited about. And finally, looking at mega-caps, we've got negative risk premium, meaning you are essentially expected to lose money by investing in those stocks instead of bonds. Now, historically, you would want, on average, at least 4 to 6% risk premium to have a good deal investing in stocks. So even relatively cheap, medium-sized companies of S&P 500 are actually not that cheap if you can have 4.5% risk-free yield on US Treasuries. And here's the chart of equity risk premium adjusted for inflation. I have drawn two trend lines that markets used to follow for a long period of time. These trend lines would tell us that risk premiums usually reside above 4% level. There were occasions when it dipped below, and it's usually during the bubble times. So, in summary, this analysis shows us that stocks are not really cheap. In fact, some nuances might suggest that they're actually overpriced. But it really depends on how long the interest rates will remain elevated. If inflation is truly to be entrenched, then the interest rates will hover above the 0% level for longer. In this scenario, yes, the stocks are currently probably overpriced. Should the opposite scenario be true, then at current levels, stocks seem to be fairly priced. In the end, investors are always looking forward, and currently it does seem that most of them expect the better outcomes, and so the stock markets are priced accordingly.